Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is Long Verticals and Diagonals. And today I want to talk about those traders who use charts in the planning of their options trades. And we're going to be discussing 3 times the trader might look at a chart and say, wow, today is the day to buy a long call spread. So that's what we're going to be discussing. 3 specific different signals that a trader might recognize on a chart that says time to get in. So before we can dive into the particulars of that, I first of all want to say hello to everybody who's joining us out there in YouTube. Great to see Shantha and Kevin, Janelle, Will, Robert, Ricebird, Susan, David, Sharon. Who else is here? Miss Street Fortune, Greg, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the recorded presentation, but be aware that you're invited to join us in the live discussion if you'd like to be here. This is a Thursday webcast series. It kicks off promptly 11 Eastern time. We'd love to have you here. And I also want to let you know that my very good friend Kevin Horner, I've been working with Kevin for years now. He is a fabulous instructor himself. He's going to be hanging out in the chats with the live stream audience, addressing any questions that I can't get to as long as they're on topic. So thanks for having my back there, Kevin. And Kevin and I would also like to issue an invitation to everybody watching, whether you're in the live audience or you're watching on the recording. Follow us on X. It's the best place to connect with your favorite presenters in between the live streams. So you can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. But let's get to this discussion of using charts to plan when to get into a long call spread. And as we do, of course, we need to pause, first of all, to consider the risks associated with trading. They certainly apply to options as well as other approaches to the market. So these disclosures are important. Bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only, should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's talk about how our time is going to be spent together today. The first thing that we're going to do is go have a look at existing positions in our example portfolio, see if anything needs to be done with those. Then we're going to look at market conditions to set the stage for a discussion of long call verticals. And then we're going to give the bulk of our time to a discussion of planning and placing a new long call vertical spread in our example portfolio while looking at 3 different signals that a trader might recognize on a stock chart that says today is the day to get into this spread. Obviously, none of those signals are going to be a guarantee of performance from trade to trade, but what might a trader be looking for on a chart? I think that's a great topic. So let's go right to Thinkorswim. We're going to be using the Thinkorswim desktop trading software platform. And right here we find ourselves on the monitor tab. If you haven't used Thinkorswim before, this can be downloaded for free from your Schwab Online account. Just go to the trade tab and you'll see Thinkorswim there. But right now we're in 2 positions. One is doing great. The other one was doing okay until this morning, and then it's had a kind of a reversal of fortune there. But let's look first of all at Cisco. So with this, we sold the 62.5 call, bought the 60 call. So when we own the lower strike and sell the higher strike, that creates a long call vertical, which is what we're going to be doing again today. We're in 44 of those contracts that we paid a net 90 cents for. And right now it looks like they're worth about the difference between the long and the short, about $1.14. So moving in the right direction, we have an order in to get us out. There's an earnings announcement that's coming up in a couple of weeks, I think. But in order to get us out potentially, if we can get this value up to $1.70, if not, we're going to ride right on through that earnings. But right now, that trade is doing fine. If it's helpful to see this on a chart, let's go to our chart of Cisco. Let me clean this chart up just a little bit. We'll circle back to that in just a moment. But in any case, we entered this trade right here. Our long strike is right there at the 60 level, so I drew in a line to represent that. Our short strike's a little bit higher. Let's click and drag on this right margin so that we can see where that short strike is. This thing has some work to do to get up there to the maximum theoretical gain position. We need to get up here above 62.5, but we have until February 21st to do that, and we're off to a decent start. And there is that earnings announcement to maybe provide a little jet fuel to this. Maybe if it's underperforming, it could kick us up there. It also could cause the trade to reverse and go down. But we're going to let this work for now. Seems to be working fine. So going back to our other trade, this is the one that we discussed last week, where we talked about what might happen if a trader committed to a single option position for an entire year. So we structured a longer-term diagonal spread by buying a $520 call on United Healthcare that has 729 days left till expiration. And then we also sold initially a 560 call against that position, creating that diagonal spread. That one only has 36 days till expiration, creating a preference for price to go up as far as it can above 520, but stay below 560. And initially, it was doing just that, but yeah, not doing that right now as of today. So let's go look at the charts. So here's United Healthcare. So we entered this position right back here. You notice I kind of split the difference between this white candle and this red candle. The white candle was on the 8th. The red candle was on the 10th. Notice there's no candle for the 9th. That's because markets were closed on that day. And yet paper money was kind enough to fill our order for us anyway. That obviously would never happen in real life. But yeah, so we took that position on the 9th, and the stock started going up. We hit this earnings announcement. Apparently shareholders aren't satisfied with what they heard, at least initially, and the price has fallen, which does illustrate that there is risk over earnings announcements. However, you might be wondering, Cameron, why didn't we avoid earnings? Well, if the plan for a trade, whether it's a stock position or an options trade, if we're going to hold for a long period of time, if we're trading domestic securities, trading on the U.S. stock exchanges, earnings are just a fact of life. So they really can't be avoided. We took that position. Some earnings might go for this trade over the course of the next 12 months. Some might go against it. We'll see. But this one initially removed us, or took us back from profitable territory and set us back to loss territory. Now, this might sound dramatic. Down, okay, 167 bucks net on the position. The call that we bought for about 102 is only worth about $94 now. However, the short call that we sold for 955 is now down to about 327. So we're sitting on about a 6.25 unrealized gain on that short call. And here's what some traders will do when a trade appears to be going against them, at least a portion of the trade, that what they may do is focus instead on the part of the trade that is going well. And in this case, that's our short call. So what might we do with this position? For some, they might say, you know what, this is opening a window of opportunity where we can relatively inexpensively buy out of that short call, take that out of the equation, and now we just have the long call, and it's now unfettered by a short call. And if it turns around and goes up, there's no cap to its potential gains. That's a possibility. It would cost us probably a little bit over $3 to do that. The advantage here is that we no longer have this short call if we get that rally before February 21st. The disadvantage is we can't make any more money from that short call. So there are pros and cons. What should we do? I think I'm going to leave this one alone. We'll come back, we'll revisit it again next week and see would it cost us more to get out of that short call? Is the stock continuing to fall? We'll look at that, but for now we're going to leave both of those positions intact, and we're going to plan a new long call trade for this portfolio. So let's go have a look first at the markets to see, does it appear to be a sort of market for a long call vertical position? So for some traders, what they'll do is they look at an index like the S&P 500. It doesn't always have to be the S&P 500. It's the index that we're going to be referring to most commonly in this webcast series. But what we're trying to gauge is if we're planning to do long call verticals, that's a bullish strategy. And therefore, the trader might want to really have some conviction or commitment that the markets are actually bullish. So here's what's been happening. Let's look at it through at least one technical lens here. The markets have been going up. Looked like maybe we're forming a bit of a head and shoulders pattern. And there was a question here for a couple of days. had we broken that neckline. Was anybody else watching this head and shoulders and thinking, ooh, this might not portend good things for the S&P 500 when we broke that neckline? In any case, we broke the neckline, but just touched off this upsloping trend line, and we bounced higher since then. And today we're actually up again. So let's just suppose that our trader who's planning the management of their portfolio here is still convinced that, and let's put on another February contract. Kenneth, you were watching this. Janelle, you were keeping an eye on this head and shoulders. I suspect you weren't the only ones. But in any case, let's say that our trader goes, whew, okay, head and shoulders appears to sort of be a failed bearish pattern. We've moved back into bullish territory, and they think we might be able to squeeze out another bullish position through that February expiration. So let's just activate this previous drawing and say, here we are. Maybe they think we're heading up from here. Time will tell. We never know for certain, but we've just made our best guess, right? So now let's go build that bullish trade. But before we do, we've seen some bullishness from the stock market, but what might a trader look for on a stock chart itself that might signal that it's time to get into a bullish trade like a long call vertical? Well, there are a number of different technical approaches, right? Just because I say here are 3 examples, it doesn't mean these are the 3 examples and that's where the list ends and it's the top 3, and no, there's none of that. But there are 3 potential signals that a trader can learn to recognize that may signal that it's time to get into something bullish, like a bull call spread. So let's look at an example of the first, which is going to be a break of resistance on a price chart. And boy, I saw quite a few of these today. I probably should have noted even more of them. But let's look at Wells Fargo, for example. Here's a stock that was going up by leaps and bounds, higher highs, higher lows. It pulled back down to this gap up. So already a trader might have a suspicion, if we have an upward trending stock that's pulled back down to a support level, well, that's a possible bullish sign. But for a little while here, Wells Fargo channeled sideways. And interestingly enough, as we sit here in the thick of earnings season, what was it that kicked this into a new gear? Well, as this was going sideways, maybe traders were hitting the pause button to see what happened on this earnings announcement. And this one seems to have received a fairly warm welcome, and price pushed up through this price ceiling. So during this consolidation, what traders might look for is where are those price ceilings? And if we can push through that, maybe that signals that traders in general of this security are ready to take the stock to new levels. Is that what's ultimately going to happen? Again, time will tell. But this is what we call a resistance breakout signal. And sometimes it happens on horizontal axis like this when a price is going basically sideways. Other times we might get breakouts from a downward slope. Let me see if I can find an example. I think Home Depot was more of a sideways breakout. Yeah, this is much like we're seeing on Wells Fargo, where the stock had pulled down to a support level. It also established a price ceiling with a couple of touch points here. And then we got a break through this, in this case, in the absence of an earnings announcement. This would have been some other news, something else that got shareholders newly enthusiastic. But breaking through price ceilings like that can sometimes signal that, yeah, traders are past a period of hesitancy and they're ready to take the stock to new levels, and that might signal it's time to get into bullish trades. But at other times, the resistance doesn't present itself as just a nice, neat sideways behavior. Instead, it might look more like, was JPM? Yeah, there we go. Here's JP Morgan, another financial stock, making higher highs and higher lows. And it pulled down over the course of these last 6 weeks. You can see, obviously, not a lot of great enthusiasm net between buyers and sellers. The buyers were not enthusiastic, more selling than buying since this peak back here in November, driving prices down. And what some traders might look for as the signal that that behavior is over and we're ready to start to move up again, is they might look at drawing a line across the peak. So I think this one, we might have made a little bit of an argument to draw this just a little bit differently. Let me activate this drawing. Some might have ignored that one extreme high, and just so that we can get more what we call touch points, maybe they draw that a little bit lower, less severe, diagonally sloping downward trend line. But as long as that's intact, the assumption is, hey, maybe this selling isn't over. But if price can push up and through that, in this case, look at that, happens to coincide with another earnings event, maybe that's the signal that price is ready to run again. So breakouts, horizontal or diagonal. Did I have another example here on ISRG? Intuitive Surgical, I think, just broke out. Yep, this is more of an example of a horizontal breakout. But just put yourselves in the shoes of a trader of ISRG. Maybe you owned the shares back here, and the price was rising up between 540 and 550, and it sagged back. And then it got back up to 550 and it sagged back, and back up to 550 and it sagged back, and back up to 550 and it sagged back, back up to 550 and it sagged back. You can see how that might influence a trader's outlook on a stock. And when we finally break through that level, it can come through as essentially a group shared moment of relief. Oh, good. We put that behind ourselves. Maybe now we're ready to go higher again. Let's see. Carol, I'm just reading through. Oh, okay. Just making sure I'm not missing any questions there in the chats, and it looks like we're good there. We do have an earnings announcement pending on Intuitive Surgical, but that is potential chart signal number one. Chart signal number two is for those traders who prefer maybe not to get at highs that have gone higher, but instead maybe their preference is for new bullish entries, trying to buy when price is low and set to go higher. And that is what we call a support bounce, where we found a price floor and started to rise again. So maybe a couple of examples. I think Apple is fading a little bit, but I'm going to use that as an example anyway. So once again, let's put ourselves in the shoes of Apple, traders of Apple. And we had this price ceiling that set in right about midsummer. We got up to about the 235 level, and it sold off relatively hard, gave back quite a bit of price territory, regained that territory all the way back up to 235, sold off again, back up to 235, sold off again, peaked through 235, but sold off ultimately anyway. So this was a pretty solid price ceiling. And we finally got up and through that right here as we moved into November. So for months, buyers were struggling with some futility here, and we finally get up to brand new price levels, really touching the 12-month highs. What was that? Maybe on November 29th, even into the first week of December. There's an example of a potential breakout like we just discussed. And in this case, it was met with a lot of enthusiasm by buyers, but then we had a peak, sold off, and we've come back down to that price floor. And there's an assumption in technical analysis. Obviously, like any assumption, it's just an assumption until it proves accurate. But an assumption here is that a previous price ceiling may be territory that traders are reluctant to revisit and may act as a new price floor. And so as we pull back, some traders will look for a touch near that price floor and then a close above. So I'm going to zoom in on this. So what we'll see, since we hit this peak back here on December 26th, we're pulling back. The next day we hit a new low. The next day we hit a new low and a new low and a new low. As we hit lower lows on a day-to-day basis, the traders might keep an eye to see if the highs and lows reverse from there. So, for example, here on January 2nd, we hit a new daily low. The next day, we didn't go any lower, and we actually started to rise again. So now the lows might be going higher, but the highs didn't get there. And we start pushing lower again. Ultimately, what we've seen is that since the 26th, the day after Christmas, it's been all the way back to Christmas, this was the lowest low established by Apple. And for some, they may look to see, can we get a close above the highest point of that low day, a bounce, getting momentum going back higher on the stock. And you know what? Yesterday we did on Apple. So for some, this might have been a signal. Maybe Apple's starting, it might be ready to go back up. Not off to a great start today. So we'll see if that can continue higher. But this might be an example of a support bounce. And we've seen other examples of that on other stocks like AVGO, I think. Let's take a look at Broadcom. So here's Broadcom. It was going sideways. Just stuck going sideways through this time frame. Earnings announcement kicked it into a higher gear, gapped up. And for some technicians, when we get a strong gap up, there's an assumption that a price floor is likely to settle in at or above that gap. And that's just what we saw here. We pulled down, touched the floor around 220, rallied up to about 250 almost, and then we've come back down to about 220. As we've pulled back, those lows. So here's our highest point. Back there, oh, look at that again. I didn't notice this before, but December 26th again. The lows start going lower, 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 lower. Oh, we got a higher low here, but didn't close above the highest point of that low day, and then the lows start going higher, start going lower again. So most recently, here's the lowest point we've run to since that December 26th high. That candle is the lowest, and so for what some traders might look for to get momentum going the other direction is, can we close above this highest point? On a couple of occasions, we teased above that high, but just came back. Teased above that, came back. Right now, we're in position to possibly close above that high. So if Broadcom could just finish out the day, for traders looking for a bounce off of a price floor, this might be it. Ricebird says you got a credit spread on AVGO. You hope it continues in that direction. We'll see. And spoiler alert, Ricebird, we're gonna put a trade on this one today. But that's signal number 2. So we have a break of resistance or a price ceiling. A bounce off a price floor is potential chart signal number 2. But still, for other traders, they like to use other technical tools. They like to recruit what we call technical studies or technical indicators. I want to go back here to our Apple example. And some traders will use indicators like oscillators. Could be RSI, could be CCI, it could be stochastic. Today, let's use a MACD histogram as our potential signal. So I'm going to go to MACD. Let's load up the histogram. We could just choose the plain old MACD, which is a different visual representation of the same technical data, but I'm gonna choose the MACD histogram. Let's apply that to our chart and click OK here. And what a trader might look for from this histogram, if you're not familiar with the MACD, it just consists of a series of green hills and red valleys. Green hills and red valleys. And when we get a really steep green hill, for some that might mean that there's really strong momentum in price going upward. When we tilt over, when the bright green starts to shift to dark green, it may be a signal that bullishness is reaching a possible exhaustion point. The actual exhaustion might be recognized if green transitions to red, which it did right here. You can see that kind of coincides nicely with that peak. And then we shift into bearish momentum. So this is a momentum measuring oscillator. Right? John was making reference back. I don't know if you're talking about this one, John. Janella said you've always wanted to understand the MACD. What you might do, Janelle, is go to our channel. You can type in MACD and just look for one of the webcasts I've done where I just focus on that indicator itself. And I talk about how it's built and how it might be used. But basically, traders using an indicator like this, they might just be looking for significant reversal points. And one of those points is when we dip low on this red portion of the indicator. The assumption here is that means that the sellers have the momentum in the short term, and you can see this typically coincides with bearish movements on price in the short term. So momentum in price is going down, but just watching price can be tough. What the trader might look for here is for the indicator to shift from a bright red to a dark red. That may signal, so let's look at our most recent example right here. When we shift from bright red to dark red, it might signal that price is ready to start going up again. Doesn't always work, but that's a typical interpretation. And if it does, what might that do for a bullish trade like a bull call spread? Well, that's just what we'd like to see. So it looks like we had a kind of a shallow example right here. Very, very shallow dips below that zero line, getting a very small bright red, shifting to an even smaller dark red. That's generally seen as maybe a lower quality signal that price is about to rally. In this case, it still worked. We had a couple of signals here, kind of back to back. One might have been a little bit early, because you can see price went down a little bit after that, but then had its rally. Here was an example here of a signal. Here was an example. This is probably the best example of a failed signal if we look back over the last six months. Right here, we had a pretty steep drop in the MACD, which some traders explicitly look for. We got a nice bright red histogram bar here transitioning to dark red, and that was signaling about right here that price was set to go up. It went up for a little bit, and then we got this. We had this right in front of us, so yeah, that was kind of a technical indicator versus an earnings event, which is really difficult to anticipate which way they're going to go. But in this case, we got kind of whipsawed. Now, the next one turned out to be a little bit better. Nice bright red transitioning to dark red, signaling right here, not at the bottom, but maybe momentum's ready to go up from there. So for some traders, that's just what they look for. And that was quite what we were getting on Apple yesterday when we were bouncing off this possible support. This was kind of being confirmed by bright red transitioning to dark red. In this case, though, maybe it's off by a day or two, could be longer. We'll see. But yeah, for some traders, the third signal comes from a technical indicator such as the MACD. I'm using the MACD as a stand-in. There are a whole bunch of other momentum oscillators in the same general category as the MACD. So I kind of rattled off a few. I'm sure some of you can rattle off some more. So I already said RSI. I think I said CCI. I said stochastic. What are some other ones that traders might look at, you suppose? Go ahead and chat those in. But let's go back to our AVGO trade now, our AVGO chart, and see what's happening here. In this case, we have a pullback down to that support level. Plus, it looks like we're working on confirming a bounce today. But also, our MACD has dipped low and has started to rise. So for some traders, it may not just be a single signal. It might not just be the breakout. It might not just be the bounce. It might not just be the MACD all by itself, but maybe they look to see, are they confirming one another? Okay, John says, what about the stochastic distance oscillator? What about, Jerry says RSDI or RSI? Carol says percent K, percent D. Yeah, that is getting a little bit deeper into the indicators than I wanted to go today, because then it changes it from a options discussion to a purely technical analysis discussion. Money flow, Dragon Rider, which is also basically every once in a while your presenter can kind of lose his mind. The on-balance volume indicator. Yeah, money flow and on-balance volume, basically the same. Yeah. ADX, Sunita. Yeah, all of these, what a trader can do is just learn how they're built, how they might be used, and can they potentially be brought into the planning of a trade like a bull call spread, or even a bear put spread when we get to that. Yep, they could. With any of those, of course, no indicator is perfect. It's not my objective here to say that MACD is the best indicator out there, But for some, they will look for a combination of factors. Bounce off support confirmed by the MACD. Others might just trade them in isolation. As long as they have a bounce off support, great. As long as they have a dip in the MACD with a transition from bright red to dark red, good enough. What I will say, though, is that a MACD confirmation almost never occurs as a combination with a breakout signal. That's because if one is looking for the MACD to be going down, guess where price probably needs to be going as well? It's probably going down, not going up and approaching a resistance level. If we're going up toward a resistance level like here, which direction is the MACD going? It's not going to confirm a red entry signal. So if we're looking to combine MACD with one of the earlier signals, either breakout or bounce, it's going to be bounce. All right, so let's go ahead and do a trade on Broadcom. We've covered all three of our potential chart signals. How do we structure this trade? Well, last week we talked about, it wasn't last week, it was the week before, we talked about maybe going in the money versus out of the money. In the money with long call spreads is a higher probability trade with a lower reward potential. Out of the money, when a trader is really convinced that we're going to make a strong move to the upside, going out of the money on a call spread, on a long call spread, can introduce more reward potential, but at a lower probability of success. It's kind of a teeter-totter effect. Higher probability of success, lower reward potential, or vice versa. Let's go, for today though, we're going to go back here to the 21st of February. And we could choose a different expiration. I'm just going to go with the 21st of February for today's example. And let's go with, since we did a lower probability, higher reward trade last time, boy, there we go. I was kind of jumping around there for a moment. But in this case, let's go for the higher probability, lower reward scenario. Now, it doesn't necessarily mean truly low reward potential. As a percentage, vertical spreads can still offer a very high reward potential compared to other strategies because they also have just higher associated risks. But let's go for, I wonder if we were to look at maybe buying the 220, selling the 225 call spread, what might that be available for? Let's come up here to where it says spread single. And if we change that to vertical, what that does is it pairs up the different strike prices one with the next. And so then we can just quickly, at a glance, see how much it might cost to set these trades up. So the 225, 230, what about the 220, 225? I think, was that the one I was looking at before? Let's switch it back here for just a second. Yeah, let's look at that one. This has, if we look at the delta as our general gauge for the likelihood of success, if we were to do the 220 and the 225 spread, what we'd like to see is for the stock to be above that spread at expiration or expiring in the money. And our delta, among other potential interpretations, delta can tell us the relative leverage of an option, but it also can tell us the relative likelihood that a contract expires in the money. And in this case, there's about a 66% chance that we're above 225 at expiration, about a 2 out of 3 chance that we hit maximum theoretical gain on this trade. So how about we look at that one? So if we go back to a vertical, we can see that looks like that's trading between 310 and 390. Splitting the difference there might have us around 350. If we spend $3.50 on a $5 wide spread, that leaves $1.50 for potential reward. Okay, so let's maybe do that. I'm going to click on, well, is it helpful for you? Let me know. What I typically do here, I tend to be as deliberate as I could possibly be with the structuring of these sorts of things. So I think it's useful for people who are just learning these trades if I break them out into their component parts. So let's do this. Let's do a long call vertical. And this is what this one's going to consist of. We are going to buy the 220 call, and it's the 21st of February. And that looks like that's trading for between 1860, 1905, splitting the difference there. Let's say it costs us 1885. It looks like it may be 1880 at this point. You can see that's bouncing around quite a bit as we're talking. But at the same time, now AJ says, isn't selling an in-the-money option increasing the assignment risk? It certainly is, AJ. However, what do we want these contracts to do at expiration? The ultimate objective here is to get assigned. Yeah, what we'd like to do is get assigned on the short option, exercise the long, and I'll tell you exactly what that would result in just a moment. So if that were to happen sooner, is that a negative outcome? Oh, I thought I was going to get my best case outcome at expiration, and my best case outcome happened before expiration. Yeah, so we tend to combine the word assignment with risk. And that's not necessarily always the case. Maybe assignment is the objective of the trade. So, yeah. Have we elevated assignment? Yes. Have we elevated assignment risk? A little bit of a misnomer there, depending on the trader's view of the trade. Okay, so let's go to the 225 strike here. So we're going to sell the 225 call, and that looks like that's trading for between $14.90 and $15. We'll call it 15 bucks. And I would bet, let's see if that 220 has narrowed up. Yeah. See, I said it was going to cost us $18.80. It's nowhere near that at this moment. It's more like $18.40. So let me back off on that price. But in any case, the net between those two, so if we buy the 21st, or if we buy the 220 call for $18.40, and then we sell the 225 call for 15 bucks, that leaves us with a net debit, which also represents the maximum or theoretical maximum loss of the trade of $3.40. So this is how much we're spending. That's how much we're risking. What are we getting for the money that we just spent? Well, we know that we now have the right, assuming that we get filled. Let's say that we get filled for $3.40. Well, that gives us the right to buy shares for $2.20, but we also have the obligation to sell shares for $2.25. Someone has the right to call shares away from us for $2.25. So to go back to the question there, what if they were to say on day two, maybe we get into this trade and the owner of the call that we sold says, hey, Cameron, I want your shares. I'm going to pay you $2.25 for them right now. Couldn't we just say, okay, well, that's fine, because I'll go buy them for $2.20. I'll sell them to you for $2.25. And that's a $5 profit, except it costs us $3.40 to set this whole deal up. So the theoretical maximum gain on this trade is $5 minus the $3.40. And that maximum theoretical gain is achieved. There we go. It's achieved if assignment and exercise happen. Yeah. Miss Street Fortune says, so as long as the price stays above both strikes, we profit. Yep. What we'd like to do is just get closer and closer and closer to expiration. What that will do, as long as we're above our strikes, it's increasing the profitability of this trade. Now, there can be scenarios where it's not actually profitable if price stays where it is for a day, but volatility changes significantly. That can temporarily change things. But the closer we get to expiration, and really the longer we stay above our strikes, or the further we get above our strikes, the better chance this trade stands of ultimately resulting in a profit. Okay. How might the trade fail? Well, what if the stock were to fall? What if it goes down below 220 and both sides of this trade just expire worthless? That's not what we want, because if they expire worthless, we lose our 1840 investment, and we have a little bit of a consolation prize. We get to keep the 15 bucks, but that would result in our loss of $3.40. So if you want to see that on a chart, the way we're structuring this, You have the 220 and the 225. So 220 is our support level right here. And then our 225 is just above that. It's going to be about right here. There we go. Now, for this reason, some traders might say, you know what, maybe what I'll do is move my strikes down so both of them are below support. That will make the trade more probable to work out, but the reward potential of the trade will go down. Yeah, if the stock were to fall down here, this is not where we want the trade to go. Let's edit the properties of that box I just drew. I'm going to make that a red. There we go. This is where we don't want to go. This is where we'd prefer to be. We don't have to be there every single day between now and expiration. If we would dip down and then recover, that still puts us into maximum gain territory. But that sort of illustrates what we'd like out of this trade. Let's go place the trade. How do we place the trade? Quick way to do that is to switch this spread back from single back to vertical, and then just click on the ask price to create that buy order. So this creates a buy order for one contract. It looks like the price has come down a bit. I'm going to offer more. Oh, yeah, it's jumping around quite a bit. Let's see if we can get in for 350. When we have markets open, I'm going to lock this in at 350. There we go. Okay, so we're offering to buy into this vertical for $3.50. That leaves $1.50 of potential reward, but the 350 represents the maximum loss on this trade. So if we can only afford 350 bucks of risk, we might just leave it right there. In this $200,000 paper money portfolio, let me come over here. You can see here's our $200,000. We've decided to risk about 2%. That's $4,000. That would allow us to do 10 contracts would be a $3,500 risk. 11 contracts would be $3,850. Let's do that. There we go. And we're going to click confirm and send. Let's buy these verticals for $350 if we can. There is a commission to be paid. Let's send this trade off and see if we can get a quick fill. But there we go. So we're in actually at $335. Okay, great. That leaves a $1.65 that could be made. So now the question was just posed, when might we get out? A number of different ways a trader might plan for that. If the trade is going really well, it looks like we might be able to make $1.65 over the course of the next how many days? 36 days. Well, what if we get a week into this? How many of you had this happen before? You're thinking you're making $1.65 in 36 days, and the stock makes a strong move in the right direction, and after a week, you've already made half of that profit. For some traders, they'll say, if I can make more than half of the profit in less than half the time, I'm going to take that off. But in any case, what we've also done with making sure that we've not invested more than $4,000, we don't have more than $2,000 of the portfolio size at risk. If the trade starts to go south on us, that might buy the trader some more patience to let the probabilities work. So we're going to keep an eye on this, see if we can make our profit to the upside. We might consider getting out early. Time will tell. But for the downside, we're going to be patient with it. All right, but guys, we've accomplished what I set out to do today. We're going to be taking a look at this trade in the future webcast. Let's move that to our long verticals and diagonals group. So you can do that just by right-clicking and say Move to Group. But we have talked through our existing positions and looked at the markets, and we spent a good amount of time talking about what a trader might recognize on a chart that may signal today's the day to get into a long call vertical. And then we placed an example trade. We're going to be managing that trade and our other trades in future webcasts, so make sure that you're joining me each week, or just watching the archives is great too. But also make sure that you have subscribed to our Trader Talks channel on YouTube. It doesn't cost anything. Just pop down there, click on that subscribe button down below my video window right now, and that subscribes you to the channel. And the channel this is the best place to find our playlists of previous webcasts. You can also join our live streams here, or you can do searches for topics of interest right there. Now, another thing that I would suggest that everyone do, whether you're watching live or you're watching on the archive, is to follow Kevin and me on X. It's the best place to connect with your favorite presenters in between the live streams. You can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS, but that doesn't cost anything to follow us as well. Everybody, thanks for giving me the thumbs up. I can see that 65 people have already clicked that like button. Thank you for making that a habit. If you enjoy a webcast, make sure that you're giving the thumbs up, clicking the like. It's a pat on the back to your presenter for their efforts. It also gives that presenter, in this case, my webcast, a boost in the YouTube algorithm, helps us find a wider audience. Kevin, thanks for helping out in the chat. I don't believe I saw a survey come in through the chats. Nope. So we're in good shape to wrap it up. Everybody, go enjoy your day. Lots more webcasts to come today, so go enjoy those. I'll look for you in a future webcast on the channel. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.